Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's cross over to tech, to Tesla. Samsung Electronics will produce AI semiconductors for Tesla in a new $16.5 billion pact that marks a win for its underperforming foundry division. What does this mean for our friends at Tesla? Craig Trudell joins us, Bloomberg Global Autos Editor here. Craig, talk to us about what Tesla's trying to do here with this big deal with Samsung.
Yeah, so this is a deal for a next generation AI chip for Tesla. So Samsung is an existing supplier of these high-powered semiconductors that are used for its driving systems that it markets as full self-driving and autopilot. And contrary to those names, that you cannot buy a Tesla today and have it drive itself for you. You still need to pay attention and keep your hands on the wheel and eyes on the road. But it is the case that those systems are becoming more capable, and that Tesla's trying to kind of press the issue with them to the point where they're taking people out of the driver's seat and having supervisors in the passenger seat of cars in Austin, Texas, and trying to take that elsewhere as well. This will be interestingly, Musk announced overnight that they will be going to a TSMC chip for the next generation of semis that they use, and then go to Samsung, relying on supply from this plant in Texas that Samsung is poised to open in the near future.
And when near future, how long does it take to build a fab plant? The cool kids say fab,
That's
right?
what they do. Yep.
Okay.
Yeah, that's right. Yeah, I mean, I think this is a project on Samsung's part that's been in the works for some time, right? And so they were sort of moved actually by the CHIPS Act under the Biden administration, and Trump was critical of the CHIPS Act, on the campaign trail, and yet we've seen sort of a continuation and somewhat of an embrace of it, as we've seen a change in the White House. In terms of the exact timing of when exactly this new AI chip will be coming out of that Texas factory, it's not yet clear from Musk's posting on X, and the companies have not said much because they of course agreed to some privacy here that Musk proceeded to sort of loosen up on
Right.
at least over social media.
Craig, do we know at this stage to what extent Elon Musk is engaged in the day-to-day, the strategic of Tesla now that he stepped back from his Doge responsibilities?
I mean, I think you can glean so much from his activity on X as to what he's paying attention to, and it absolutely is the case that we're seeing him posting more about things like this deal with Samsung, and I do think that that's helpful sort of for sentiment around Tesla. And yet, I would say too that if there was a sort of scorecard or sort of an informal scorecard that you'd be keeping track of where he's sort of devoting most of his time and attention to, I would say it's as much or more on XAI and just AI in general than it is on Tesla specifically. You heard from him a few months ago that he would really be turning his attention back to Tesla, as he was making his way out of the White House. But I think, the amount of attention and emphasis he's put on trying to catch up to the likes of OpenAI and Google in artificial intelligence and LLMs is, definitely exceeds, the amount of noise we're hearing from him about the day-to-day inner workings of Tesla.
All right. Excellent. Craig, thanks so much for joining us. Appreciate your reporting there. Craig Trudell, Global Autos Editor for Bloomberg News, joining us from our London HQ. Samsung to make Tesla chips in multi-year Texas deals.
And Elon's going to actually walk the floor.
That's what he used to sleep in the Tesla plants back in the day.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk beer, John. I mean, I'll drink a Heineken.
Perfect day for it.
I'll drink a Heineken. You put it from, especially with the heat today. Heineken beer sales fall as price dispute took longer to. What's going on with our friends at Heineken? Let's go to the go-to guy there, Duncan Fox, senior consumer staples analyst for Bloomberg Intelligence. He's based over there in our London office, Queen Victoria Street, right in the center of the city of London. Duncan, talk to us about Heineken. What's going on there?
Well, essentially, European retailers decided not or delayed pushing the prices up after, I suppose last year wasn't particularly big on pricing. It was about 3% for the global Heineken brand. But the previous 2 years, when inflation was raging, they did get 14 and 10% respectively in 22 and 23. Costs of goods are not really going up, so I think the retailers just pushed back, and it took them longer to push to get a small price through in Europe. And that's just hit the sales. It's about 50% of the overall business.
What does a Heineken cost in the pub?
Well, if you're in London, a heck of a lot. It's probably sort of £8 plus. I can be above £10.
Wow. I used to put a
which where I live in Dorset, you'd be lucky to get it. It's sort of around £5 to £6. But nevertheless, when you're pushing the price up, the premium Heineken brand, which is probably 20% more expensive than any other sort of mainstream beer that they've got on their portfolio, you can see why the volumes have struggled in the short term given cost of living crisis. So it's something they will resolve. They have resolved, in fact, on the pricing. So one would hope it will get better as we go through the second half with better weather that we've had in Europe.
So we had, I guess, the announcement of a trade deal between the U.S. and the EU. I don't think, what's it mean for the spirits business, the beer business, the wine business, asking for a friend?
I hope you've already stocked up, but 15% is probably a good outcome given some of the rumours that were going around from April onwards that it could have gone up to 200%. But obviously, the cost of beer coming in for someone like Heineken, they basically ship in from either Holland or Mexico. Some of the Mexican beer may well be tariff-free on the USMCA agreement, but then you've got the cans. So Lord knows how much that will push the price up. But they'll just have to push prices up on beer and spirits. Spirits at 15% probably say is not huge, but it'll mean pushing prices up 3-4%, something of that order, on top of what they would normally try and get. So it's not going to be easy to do, but it's not as disastrous as 30% or something like that, which Remy said last week would take profits down by 35 million euros. So a little bit better than expected or feared, but it's still not going to be great news. Wine, there really isn't anybody that exports wine that's quoted. So it's a bit difficult to say what the impact is, but it'll certainly make it more expensive compared to your good US grape varieties that come on the market. So I would have thought you'll see people switch to US wines.
I find this kind of disturbing, this part of the story where you quote the CEO of Heineken. Beer markets have declined at a pace Heineken has rarely seen any time before. Is this the end of humanity as we know it?
Well, if it carries on, I think there's been stories that the Gen Zs have given up on drink. I think that's wildly wrong. But there's certainly people are abstaining during the week a little bit. But the real problem is that people are drinking more at home rather than going to the pub. And that's sort of changed. That's the big change from COVID. So you've got to make sure you get your pricing at retailers right. It goes back to your original question. Because people are now, it's sort of more like 80% drinking at home in the US. It's anywhere between sort of 50 and 20%. Depends on where you are in the world, but a lot more people drinking at home than going to pubs and clubs. So the mix is poor, really, or has been, and it needs good summer would help, and it needs people to have a bit more money in their pocket as well. So maybe feeling a little bit more confident that they can go out and spend it with their friends rather than buying it cheaper from retailers and entertaining at home.
Duncan, I wonder if this is a national phenomenon, because it's a phenomenon on the Jersey Shore, which is people are drinking like these iced tea vodka things, the White Claws, all this stuff that's not beer. Are you seeing that? Is that a trend around the world?
He hasn't been to my beach, by the way.
Unfortunately, it seems to be that it's a trend. You get a lot of ready to drinks being pushed, and they're big for sort of 12, 18 months, and it does tend to go against the beer volume more than anything else. Spirit companies are doing it with no alcohol spirits now, and they're also pushing you can buy gin and tonic or ready to drink gin and tonic and stuff like that. So there's just a lot more choice for the consumer than there was, when I was a kid. So yeah, it just takes a little bit of the shine off. You can try new things. I would say people are spending more or spending a similar amount on alcohol, they're just buying less of it in terms of volume. So it's all about getting the value right. Premium brands are doing well. Heineken premium brand did very well in these results, but it's only 24% of their overall volume. So, 4.5% on 24% doesn't sort of help.
Is there any chance
overall.
Any chance Heineken's going to build a brewery, a factory in the United States? I mean, I don't know if it would be the same.
Yeah.
I would say it's unlikely. So that's a big commitment, and you've got to make sure that the volume growth will be there, because otherwise you're spending quite a lot of capital over the next 2 years. If you had a site ready today, and then you've got to make sure that you have enough volume throughput for that to make money for you and be better than shipping it in. Even with the tariffs, at this moment, it doesn't seem that they're likely to build a brewery in the US. But if tariffs were higher, then I suspect there would be a chance. But I mean, they're building a big one in Mexico, and I suspect they'll ship it from there.
All right, Duncan, thanks so much for joining us. Duncan Fox, Senior Consumer Staples Analyst for Bloomberg Intelligence. He's over there in London. And they shut down the Bud Brewery in Newark, right, by Newark Airport?
Do they?
I think so. I think that's shut down.
I don't know.
And there's a Bush Brewery right across the street from Newark
I didn't even
Airport.
hear about that.
Yeah, I think that's a thing here. Field trip. Yeah, field trip, exactly right.
We'll have to do some investigative reporting.
Exactly.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, we got John Tucker, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. And we are also doing that internet thing. We're on YouTube, so head over to youtube.com and search Bloomberg Live Radio, and that's where you'll find us. Tariffs. Europe, I guess we got a deal, John. So
we have a deal, but I'm still begging for some more details, especially when it comes to pharmaceuticals and autos.
True. And with all these deals, I'm expecting, don't you have to negotiate these for like a year or two, and there's like 10,000 pages agreement? Or is this just like a one-page term sheet we kind of put across the table and somebody initials it and we're good to go? I don't know.
Somebody's got answers out there.
Somebody's got answers.
It's not me.
Let's go to Brendan Murray. Brendan Murray, he's a Bloomberg Big Take story today entitled, Trump Tariffs Are Already Stunting World Growth, but the markets are shrugging here. So let's get to it. Hey, Brendan, again, another big trade deal announcement today with the European Union. They're coming fast and furious. I guess if you're looking at the economic data, I'm not sure we've seen any slowdown in the economy. I'm not sure I've seen any pickup in inflation, which were two of the concerns for a lot of people out there. What does your reporting show?
Yeah, our reporting shows that when you look at what companies are saying their capital investment plans are and what they're saying about how they're going to try to absorb these costs, whether those are in margins or passing those costs on to consumers, that these tariffs are starting to take a bite. They're not happening all of a sudden. It's this kind of slow grind on the economy that we're seeing, and you can see it in some of the surveys that the government or private surveys that are reported. So the lesson here is that you don't just flip a switch and get inflation overnight. It's a slow moving process, and the deals that are coming in from President Trump, the markets are celebrating because they're not the worst case scenario, but it still makes goods. The EU deal, let's say, makes European exports to the U.S. 15% more expensive. So that's just the bottom line, and that's not that's an economic headwind in any economist's book.
Hey, Brendan, when we hear Secretary Lutnick speak, for instance, he'll be saying something like, China is going to pay, so-and-so is going to pay, settle this for us for people who don't follow this too closely. They're not paying. It's it's a tax, is it not?
The American importers pay tariffs. They pay these taxes to the Customs Bureau. And so now those importers could go to the exporter in China or the European Union or wherever and say, hey, this is costing me an extra 15%. Can you lower your price? That happens in some cases. Most of the time, the profits of that company take a hit. They pass it on or they pass it on to consumers. But the bottom line is they've got less to invest in. They've got less money to hire people. So this is what our reporting shows today in the Bloomberg Big Take, is that we are starting to see that slow grind on the economy that tariffs have, that economists would warn you about, that are happening. Now, the Trump administration would argue, look, this is going to incentivize companies to produce more in the United States, and some of that may actually happen. So we shouldn't discount that completely. But the tariffs hurt a lot more companies and consumers than they do help. Look at steel tariffs. We've seen an increase in domestic steel prices. There are a lot more companies and employees of those companies that use steel than make steel, and they are paying the price for it.
So where will we see it? Craig, I mean, will we see it in GDP numbers? Will we see it in headline inflation numbers? And if we do see it, when do you think we will see it in the hard numbers, as I know economists like to talk about?
So the investment figures, we're going to watch this week's GDP number very carefully. This is the second quarter. The headline number is likely to see a bounce back. Remember, it was a negative first quarter. The second quarter should be something in the 2.5% range. But if you look at the part of that, those numbers that will give you a clean look at how companies are investing, that number is supposed to be flat. So there was a lot of distortion with tariffs over the second quarter. So some of that will still be some noise, but noise or not, those are companies that are not investing for the future in things like that will help their productivity and their growth.
How long does this take to wind its way through before consumers? I mean, you've already mentioned steel, for instance, but other parts of the inflation to show up in the economy?
It could take a couple of quarters. The Trump administration is rolling these deals out fairly gradually, or they're coming quite quickly toward the August 1st deadline. But they're going from 10% to 15% in a lot of cases, and so we're just going to see those costs for the American importer go up even higher. And what's really crushing to a lot of these businesses is the small businesses get hurt the most. The large retailers of the world, they have more the wherewithal to withstand some of this, but it's really the small business, and the National Retail Federation chronicles a lot of small businesses that are getting hit.
All right, Brendan, thanks so much. We appreciate it. Brendan Murray, Global Trade Editor, Bloomberg News.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.